All right, Payroll Accounting Chapter 5 has to do with federal and state unemployment taxes. Federal unemployment taxes would be FUTA, and state unemployment taxes would be SUTA. That's what I'm usually going to refer to them as. So let's take a look at these two different taxes. We're gonna look at them separately. Let's start with FUTA. So remember that unemployment tax is the tax that the employer pays to fund any unemployment claims that individuals might have, people who are out of work. So federal unemployment is levied on the employer only, not the employee. It's based on your taxable earnings, and it's at this point 6% of the first $7,000 made by each person. So the first $6,000 of taxable wages. Remember that in your textbook, back in Chapter 3, the page that we tabbed, I'm trying to find that really quick, page 87, tells things that are exempt and taxable for FUTA taxes, that little table in there, same that we use for federal income tax and for Social Security and Medicare taxes. So it's the first $7,000 of taxable wages that is levied on the employer, not the employee. So the employee does not pay this. It does not come out of the employee's paycheck. It's something that the employer pays. So once, and that's a ceiling, just like Social Security. So once an employee reaches the $7,000 year-to-date mark, the employer no longer has to pay unemployment. For that reason, it's best to keep your employees for as long as you can, right? Because companies that have really high turnover are always paying unemployment taxes on those employees because they barely make it to the $7,000 range before they leave. So that's the main thing with Social Security. With FUTA. So the actual FUTA rate is 6%. Did I say 6%? Yes. But there is a credit reduction for the states, for each of the states. And let me see, a credit for each of the states. So instead of paying 6%, they have a reduction of 5.4. They give that credit to the state. And so companies only pay 0.6%. So 6% minus 5.4 is 0.6. So it's 0.6% or 0.006 of the first $7,000 in taxable wages. This credit is based on the states, on each state's unemployment taxes that are paid, not the individual state rate. It doesn't really have anything to do with that. By the way, each individual state is going to have their own rate for SUTA. Some states become what they call credit reduction states. They don't get the full 5.4% credit. It gets reduced. The reason for that is that if a state has not taken out any loans to pay unemployment benefits, so if they have to take out loans, those loans are called Title 12 advances. The state has to take those out from the federal government. And when they have to do that, they have a loan balance. So if the state maintains that loan balance as of January 1 for 2 consecutive years and has not paid the loan balance as of November 1st of that second year, then it's going to be subject to credit reduction against FUTA. Right here it's telling us that California and the U.S. Virgin Islands are credit reduction states. They have a 1.8% credit reduction, so that 5.4% credit gets reduced by 1.8. So instead of paying 0.6% FUTA, people in those states have to pay 2.4% FUTA. Hopefully that makes sense. So California and U.S. Virgin Islands are the only ones. Let's see, anything else? I want to calculate some FUTA taxes. So let's start on page 149, and this is case in point number 1. We have, am I on the right one? Page 149. Yes, so we have 3 employees here. The Karamia Company employs 3 workers in Colorado Springs, Colorado. As of the beginning of the current pay year, or pay period, these employees have earned $42,500, $6,800, and $2,000. So I've got those at $42,500, $6,800, and $2,000. and their current pay for the current period is $31.40, so $14.70 and $1,500, which I've added in right here. So if the FUTA ceiling is $7,000, this person who already paid $42.05, the company does not have to pay anything for them. So the employee one's FUTA is zero, or the FUTA that is owed by the company for that employee is zero. Employee two is really close though, aren't they? They're close to that $7,000 mark. So of that next paycheck, $1,470, the employer needs to pay $200, or the employer needs to tax at 0.6%, $200 of the $1,470 earnings. So as you can see, 7,000 minus 6,800 is 2,000. So for the rest of the year, for employee two, the employer only has to pay 0.6% of 200. The third employee has year-to-date earnings of 2,000. So this 1,500 was not going to get them to $7,000. So they're going to have to be taxed on their full $7,000. So to calculate the FUTA, we're going to combine, the full 1,500. So the 200 plus the 1,500 is 1,700. 200 from this paycheck, the $14.70, and the full 1,500 of the next one is 1,700 times 0.6, or $10.20. So that's the FUTA tax. I think I've got another one here. Yes, number 2. Oh no, that's a different one. That's going to be SUTA. So that's actually case in point 5-2, which we are not at that one yet. So let me go back to my PowerPoint slides here. That's how we calculate FUTA. FUTA taxes are paid quarterly usually. They're paid for the first quarter, the end of the next month, basically is the rule. So for the first quarter, April 30th, for the second quarter, July 31st, and so on. FUTA payments also, if a company owes let's say at the end of the first quarter they don't even owe $500, they can wait until they have at least $500 before they remit their FUTA payments. So if the amount never reaches $500, well, let me back up. So if by October 31st they finally have $500, they're going to remit that money. If for the whole year they never have $500 of FUTA, they don't need to pay it until January 31st. They're going to pay it at the end of the year. And the end of the year, fourth quarter, is paid by January 31st. That's if they pay it with their 940. And they would usually make the payment with their 940, which we'll see in the next chapter. And that's it for this section.